Welcome back. Thanks for joining us. This is our latest edition of Chart Overload here in June. I'm Ryan Mumy, CEO of Solinda Capital Management, and with me is Mr. Justin Greenhill, our Chief Investment Officer, my co-founder, and what I calls my best friend. He says I'm an acquaintance, so glad to be here again, Justin.
Good day, good day.
There's always, we've talked about this, but we kind of forgot about this risk in markets, or this input called headline risk. We'd forgotten about it, but we've been welcomed back.
Welcome to the headline.
It's live and it's real. It's driving things around. Let's get started. Big picture. Obviously, all eyes are on the global trade right now. Trade, tariffs, dialogue back and forth before countries. This seems to be, a big input right now on investors' minds. So we thought we'd open with this little chart, keeping it all in perspective.
This is really important to take note with the U.S. and China, top of the trade headlines. It's important to really just grasp how big the United States and the Chinese economy is, both individually, but especially collectively compared to the rest of the world. So this graphic does a good job in capturing that.
Yeah, dominated by the U.S. and China. Moving on, again, big picture, foreign investments. We've talked about this in past chart overloads, but this has gotten some additional press recently with the diving into the big beautiful bill that passed the House and is in Senate now. Domestically, Section 899 is on a lot of people's minds.
Big beautiful bill, triple B. So yes, what this shows here, and we've showed this a few times over now, is this is foreign investment in U.S. assets. And in particular, what this particular Section 899 is talking about doing is imposing an additional tax on not just dividends, but on appreciation of those assets. So the theory would be is that, with an additional tax headwind to these returns or to these positions, foreign investors might be even more incentivized to resell and repatriate those assets.
Yeah, which we have some additional data to look at this later on. Again, looking at this a little deeper, this topic, Asia is notably long U.S. assets, as this just chart shows.
Yeah, and that makes sense to think about. So the Asian economies have been the economies that have exported a lot to the United States, which means they receive dollars, which means they have then taken those dollars and bought U.S. assets, both bonds and stocks. So there's a few different catalysts that could potentially undo that on the margin, but one of those is most certainly the Section 899.
Bears watching. Inflation, not so much has been in the headlines as much of late, but it's still lurking. And this is just interesting that we've talked a lot about people's biases and taking that in consideration and looking at different data sets. And this is another one relating to inflation expectations, forward expectations, which the data has been really noisy and really high. But this we found this very interesting.
Inflation is lurking.
Yeah,
so like everything else that's happened of late, inflation or expectations for inflation has become politicized. So it looks like here, if you're a leaning Democrat, you think inflation is going to surge. And according to this graphic, if you're leaning Republican, you think inflation is about to collapse and things are going to become more affordable. So we'll see how that plays out. But as you can see in the graphic, historically, there's not been this divide.
Yeah, historically. Next chart looking, the PCE inflation came out last week. It was a little cooler than expected. So this dives a little deeper into the demand components and supply components of that PCE inflation indicator, which shows a little dispersion.
Yeah, what's interesting about this chart is it basically shows that the so-called supply driver of inflation has come down dramatically since its highs post-COVID back to what was pre-pandemic levels. And what is any remaining inflation in the PCE data is a demand function, meaning that, people are still out there demanding goods and services. So any potential impact of tariffs, assuming those are inflationary, those have yet to show up in the data.
Which they are lagging, but we shall see as things continue to get paused and pushed out and paused and pushed out. What's narrative versus what's reality? And that's TBD. That's why we keep waiting on the data. Let's move on to stocks, U.S. stocks. First chart here. We had a really good May. So much for sell in May and go away. It didn't necessarily play out this year.
Yeah, it was the opposite. So as you can see in this chart, April was a very volatile month, but May saw a big snapback. So one of the bigger months for the S&P 500 going back many, many, many years.
Yeah, this goes back 35 years to that great year of 1980.
A wise man was born then.
Yeah, allegedly. That's good. Moving on to the next one, we've talked about this in our weekly commentary, but the S&P is, the major U.S. benchmark is at a critical spot. Lots of things are, lots of different indicators moving in around this same level, same spot. So we thought it important to show a little chart here.
Yeah, so as you can see here, highlighted by the yellow line, market.
Which your art degree it's getting better. I mean, your drawings are improving.
The local community college served me well.
Yeah.
Basically, the market is back above what was, the pre-Liberation Day levels, but yet it still has been kind of putting in what could be a little bit of a near-term top here below what was the prior all-time high. So we're kind of stuck in no man's land in terms of a big picture trend standpoint.
And we've got all these moving averages converging around the same level, which happens to be right between that pre-Liberation Day level and the current levels, as well as that gap that formed on the U.S.-China de-escalation.
Yep.
Moving on, we spent some time in preparation for this. Believe it or not, we do prepare for these. I know it may not seem like it always, but this shows a breakdown of S&P 500 returns by time frame.
Yeah, we find this to be very interesting. So as you can see, prior to so-called Liberation Day, the lines were pretty much the same, meaning that you had roughly the same amount of buying happening overnight that you have happening during U.S. trading hours. And since then, it's been the opposite. So basically, overnight, the market has been declining more than it's been gaining. And during U.S. trading hours, the market has been gaining significantly more than it's been declining. So our theory behind that is back to foreign ownership, that it looks that foreign participants who will act overnight are doing selling, while during the day, we have other data to suggest as well that U.S. domestic retail has been a big buyer of stocks since Liberation Day.
And we'll, again, as we talked about, we'll continue to watch that data. Moving on, looking at a different component of the S&P 500, the equal weight, which doesn't overweight different sectors based on market cap and just equal weights all sectors. It's lagged a little bit in this new run up.
Yeah, so if you go back to October of 2022 and you assume that what's happened since then has been a new bull market, to your point, equal weight has notably lagged, which just means the biggest of big companies have outperformed. And what's interesting about that is, in historical bull markets, that's been the opposite. Normally, you get more of a broad participation into the first part of a new bull market. So in that sense, things are different in that the biggest of big companies continue to demand, or continue to receive, I should say, more and more capital allocation.
Yeah, because traditionally in bull markets, equal weight will catch up at some point as breadth expands. More and more companies participate in the up move, and that just hasn't been the case as reflected in the equal weight. Moving on, a little shorter time frame, looking back to the bottom in April, big tech has been a big driver of this bounce back to, I think we're within 4 or 5% of all time highs in the S&P.
Yeah, and a lot of this has to do with market cap weighting of indices. So you've basically got a situation where when money goes into a S&P 500 market cap type fund, ETF, target date fund, etc., a disproportionately large amount of that money goes to what are the larger companies, and that is very much on display here with Nvidia, Microsoft, etc., Apple making up a big chunk of the gains. And obviously, solid earnings has contributed to that as well.
Yeah, and but interesting, year to date, they're still lagging. Technology and the Magnificent Seven is still lagging the overall S&P 500 year to date. In looking at that a little deeper, at that section, big tech valuations here, while they've bounced higher, looking at the multiples of them, they're still pretty richly valued.
Yep, they are richly valued, but less so than they were last year. And to the prior point, that really has about everything to do with earnings, in that earnings have come in pretty solid. At least,
and people are paying for future earnings that they think they're paying a higher multiple for future earnings that they think are going to continue to go up.
Yep, that is right.
Moving on to non-U.S. stocks, it's been a pretty good year for owning ex-U.S. equities.
Yeah, and what's interesting, if anyone remembers our commentary to start the year, we were really highlighting how long the run of underperformance of international non-U.S. versus U.S. had been. And this year has really just been a sharp reversal. So as you can see there in the blue line, that is S&P 500 returns showing up this year to date, below what is all world ex-U.S. equity returns.
In only the ninth time going back, over 35 years. So it is something to note. Moving on, looking a little deeper at Europe, which again is people. I would say if there's one area of international, just looking at international, that's under-owned specifically outside of the broad international indices, it is Europe. People get excited about Asia primarily, if targeting, getting more specific. But this shows that there's a little life to Europe.
Yep, and it's broad-based too. So as you can see here, it's the various different European country-specific markets, and the thesis is that a lot of this has to do with the fact that Germany announced a large fiscal stimulus. So unlike previous years, it looks like the European Union is going to get together and actually start pumping some money into the economy, which, as we've seen here in the U.S., is believed to be generally bullish for stocks.
Yeah, for asset prices in general. Moving on, Latin America, where this next one looks at EWZ, which is the Brazil ETF. It's been on a nice run year to date. Brazil, one of the best international country-specific stock market performance so far in 2025, and flows have followed. What's interesting about this, and we often, remind ourselves, is that historically, Latin American markets have been very cyclical, and that they're good for trading, but as a dollar-based investor, they've been far less than good for long-term buy and hold. So just as Brazil has been a very strong market year to date, it was a very weak market last year. So as we've seen performance do good since the start of 2025, we've seen some flows come into this ETF. So it'll be interesting to see if a longer-term trend can emerge here, as there is a presidential election next year in Brazil, and there is
a good amount of uncertainty, but a potential positive catalyst around that.
Yeah, and I mean that's something I was going to mention. That political risk is very real in Latin America, country investing, and it's something we have to pay attention to. Moving on, Latin America wants to trade more with China. I mean, the title of the slide says it all.
Yeah, and this probably shouldn't serve as a surprise, but we think it's interesting to point out is that, as you see on the top, even though the US is Mexico's biggest trading partner by far, a survey of the Mexican population, fascinating, is actually favors trade with China, which is something that is I found it to be pretty surprising. And if you look across the rest of Latin America, despite Central South America being on this side of the world, there is no clear preference amongst the population of these countries about who they do business with, China or the U.S.
And this is their voters, right? So politicians tend to follow to try and get votes. So that's why we're paying attention to it, not necessarily acting on it, but this is something we need to be aware of.
Well, and just
Moving
to add
forward.
one thing to that, one of the reasons that the population feels that way is they've been flooded with relatively high quality and especially cheap Chinese goods. So whether it be Chinese automobiles or, consumer items like clothes, the population sees great benefit in doing trade with China because it has, been beneficial to their bottom line.
Moving on to interest rates and fixed income. I love the use of the word docile here. Reminds me of a llama, docile animal. But we're looking at the large CTF that trades long-term U.S. Treasuries. It's but bottomed here recently when the 30-year yield ran up past 5 and it settled down last week. But it could be forming a little bit of a bottom around some critical levels.
Yeah, and we think this chart is particularly important. And the reason being is that this most recent run higher in long duration yields, 10-year and beyond, has seen bond market volatility much lower than the previous run higher in yields over the last 2 or 3 years. So the thinking is that here is yields on the long end of the Treasury curve need to hold in here. Otherwise, it's likely that could spill over into more volatility, which could affect not only other asset markets, but could require a government response.
Yeah, I mean, Scotty B, the Treasury Secretary, I mean, he's talked more about U.S. Treasury market than anything, yields being a driving factor for him and for the administration. And moving on to the next chart, why might have yields peaked and started to roll over is they were running higher on, concerns about the fiscal status of the United States, inflation, tariffs. But then last week we get some consumer data that might suggest the consumer slowing down a little bit.
Yep. So we've got that a little bit of a slowdown in the consumer, which is based on the fact that prices remain a bit elevated, and there's obviously a pretty large amount of uncertainty surrounding trade. And at the same time, we've got some critical jobs data coming out here at the first part of June, which really will be the first look at the jobs market, allowing us to see that if any of that uncertainty has actually started to manifest itself in any sort of unemployment metrics.
EBD, which the labor market's been one of the biggest bright spots, stability there over the last couple of years when people continued to think that the economy was weakening. The labor market has stayed strong, which drives the consumer. Last section, let's talk about commodities. This chart looks at the price pressure of OPEC Plus and their desire to supply more when much of the demand is saying maybe historically they would cut production.
Yep, and what's interesting about this chart, as you can see in the first, word pointed out section there, is OPEC announced a increase in supply right when the Liberation Day volatility was happening. And the last time they did that, interestingly, was actually during COVID. So there's a lot of different theories as to why this is, but perhaps the most reasonable one is that OPEC, in particular Saudi, is worried about losing market share to U.S. shale, and also is worried about some of the smaller OPEC member countries taking market share by not adhering to the quotas. So regardless of what the theory is, you have a supply side of oil that is not bullish, if not potentially bearish. At the same time, you have market concerns that demand is going to be weak going forward. So it's been a double whammy for oil, and as such, oil's dropped quite a bit.
And finally, looking at gold, gold. The commercials are everywhere. Yeah, it seems like everybody's buying and selling gold. South Park did a great episode on this topic. Anyway, so after a huge move, gold might be pausing a little bit here, exhausted.
Yeah, it could be. There's been an interesting move in gold really of late. A lot of it has had to do with potential dollar weakness and the narrative around foreign central banks, and in particular the Chinese populations in Asia wanting to buy gold. So the trend is certainly up, but we'll be monitoring for any sort of exhaustion there and or reversal.
Yeah. Always fascinating. Always a pleasure, Justin. There's, always things to talk about and pontificate on. But we appreciate everyone joining us. We know there's a lot of things you could do with your time. We appreciate you spending with us. If you have questions, want to dig a little deeper into a topic, want to try and stump the chump with any topic, feel free to reach out to us. info@solinda.com. info@solinda, solinda.com, or you can give us a call, 844-662-1211. We appreciate it. We'll be back in a couple weeks with the next episode. Have a great week.
Thank you.